Well, just to be clear, we have been riding this bull for all it's worth the last couple of years. We're not necessarily plowing new monies into the market, but there are always opportunities in the market, and this latest rotation represents another one. But as the economy and earnings continue to dwindle lower, there's going to be opportunities both here and, importantly,
well, you sound
overseas.
sort of like a bearish bull.
Yeah, how about a baby bull? Yeah.
But what is the landscape you're expecting? We've got stronger inflation data this morning at the same time that Fed rate cuts have arguably fueled some of the rebound. So what factors lead you into your sort of bias for the market?
Nominal economic growth. I mean, we'll have economic growth on the order of maybe 1.5–2% next year. It's, judging by the consensus view. Overseas, maybe a little weaker, but possibly bottomed out over there, so some opportunities there. So we could muddle through this. And again, there's always going to be opportunities in the stock market here or domestically if you're in the right sector and on the right side of the growth value conundrum.
Okay, we can circle back to that. Joe, in the meantime, how much of this is simply dependent on the trade headlines going favorably?
I think a lot of this has been dependent on the trade headlines going favorably. And let's not forget, from the beginning of this year, a huge part of this market rally has been really created by extremely accommodative monetary policy and really the 180 that the Federal Reserve took in January relative to where it stood back in December. I guess I question how much further this market rally can really continue to move up, considering the reality that economic growth has decelerated around the world. It is stable here in the U.S. We don't believe a recession is imminent, but it is likely to come down even further next year. You have corporate profits really, flat. We're not seeing a whole lot of earnings growth. Margins are under pressure. It's just difficult to imagine another leg up here unless you have a meaningful improvement in the economic data, and we just don't see that yet.
Could the yield curve steepen? And I asked you this, Joe, because while we may not have seen terrific headlines out of trade, certainly in the past month, we have seen an increase in the 10-year yield, a dramatic one at that. I mean, 30 basis points in about a month is nothing to sneeze at, and that's really what caused the markets to bounce.
Yeah. I think over a short time frame, there's no question interest rates can back up again even a little bit more on the longer end of the curve in the 10-year. But if I take a bit of a medium-term outlook, look, the reality is we're now in the longest bull market we've had in history. This economic expansion is getting very, very long. It's getting tired. And when we do eventually enter a recession, I would actually argue that interest rates are probably going to come back down, not necessarily move up. So I think the move directionally, if I take a longer-term outlook, is for interest rates to come down under pressure. It's hard to imagine the yield curve steepening from here without, again, an improvement in economic data or inflation expectations really picking up.
Rich, I'd like you to pick on something that Joe mentioned, and that is corporate profits. What do you see? Because the stock market fundamentally is discounting corporate profit in the future. What do you see for that as we head into next year? Joe sees them as basically flat. I think you do too. If they're flat, then what's the driver?
Oh, it's going to be interest rate related, no doubt. Lower interest rates at the short end of the curve. Lower discount rate makes those corporate earnings flat or otherwise more valuable today. But there's no question, earnings growth grinding to a halt across all of the major sectors. And it's a matter of you have to be very selective where you're going to find.
That's a hard environment to make money in.
Yeah, but it's all relative in our business, as we all know.
How selective, if you could be just specific on a couple of things just quickly before we go, what would they be?
Value stocks. I definitely move off of, and I think this is where we agree, move off the momentum stocks, the high growth, the FANG stocks, move over to the more value-oriented sectors, no pun intended, and get over to banks as the yield curve steepens. We have inflation popping up. We have the Fed lowering interest rates. That's a prime area for banks to do well in.
Rich Weiss.